Michael Burry insane warning. This chaos is worst in the history. Prepare for the worst. U.S. consumer prices climbed by 6.8% in November, marking the fastest pace in 39 years. And while the stock market continues to largely shrug off inflation concerns, many well-known investors have been busy sounding the alarm. Today we're going to talk all about the worst financial crash coming soon. So watch the video till the end, because today's video is going to be the bomb. Welcome to Michael Burry Secrets, your daily dose of Michael Burry. If you're interested in everything around Burry, this is the place for you. Subscribe if you want to stay updated with all the Michael Burry secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. U.S. consumer prices climbed by 6.8% in November, marking the fastest pace in 39 years. And while the stock market continues to largely shrug off inflation concerns, many well-known investors have been busy sounding the alarm. Rich Dad Poor Dad author Robert Kiyosaki is one of the more vocal ones. "Crash and depression coming," Kiyosaki tweeted earlier this week. "Time to get richer after fake inflation crashes. Be aware, take care." To be sure, Kiyosaki has made similar calls in recent months that haven't exactly worked out. In September, he told Kitco News that the biggest crash in world history would hit in October. But Kiyosaki isn't backing down from his ultra-bearish stance. In fact, he's doubling down on his favorite inflation-fighting assets. "I'm buying more gold, silver, Bitcoin, Ethereum, rental real estate, and oil," he wrote in a tweet from last month. For those who share Kiyosaki's concerns, let's take a quick look at these inflation hedges. One could be worth investing in with some of your extra cash. Gold and silver. The famous author is a longtime advocate of investing in precious metals, and it's obvious why he's still pounding the table on the two most popular ones, gold and silver. Gold has helped investors preserve their wealth for centuries. It can't be printed out of thin air like fiat money, and its value is largely unaffected by economic events around the world. Silver can also be a store of value and a hedge against inflation. Plus, silver is an industrial metal. It's widely used in the production of solar panels and is also a critical component in many vehicles' electrical control units. You can buy physical gold and silver at your local bullion shop, or you can look at large cap miners like Barrick Gold, Newman, and Wheaton Precious Metals. If gold and silver prices go up, these miners are very likely to thrive. Bitcoin and Ethereum. Some consider Bitcoin to be the new gold, and Kiyosaki likes it too. When Bitcoin surged past $60,000 in October, the author tweeted that the future of the cryptocurrency is very bright, but was just waiting for a dip before investing more. Well, Bitcoin has certainly pulled back since then, currently trading at roughly $47,660. Kiyosaki is also buying Ethereum. While Ethereum isn't as large or as popular as Bitcoin, its usage in peer-to-peer lending, NFTs, gaming, and stablecoins means it's something crypto investors shouldn't ignore. You can buy Bitcoin and Ethereum directly. Today, many exchanges charge up to 4% in commission fees just to buy and sell crypto, but some investing apps charge 0%. You can also invest in companies that have tied themselves to the crypto market. Hive Blockchain, for instance, mines both Bitcoin and Ethereum. The stock is up about 55% year to date. There's also Coinbase, which runs the largest cryptocurrency exchange in the US, with 7.4 million monthly transacting users. The company raked in revenue of $1.24 billion in Q3. To be sure, Coinbase currently trades at $270 per share, but you can own a piece of the crypto exchange using a popular stock trading app that allows you to buy fractions of shares with as much money as you are willing to spend. Real estate. Owning real estate has historically been one of the most effective ways to both hedge against inflation and earn a passive income, and these days you don't need to be a landlord to do it. There are plenty of publicly traded real estate investment trusts that provide generous cash distributions to investors. These companies own income-producing real estate, collect rent from tenants, and then pass the money to shareholders in the form of regular dividends. Realty Income, for instance, has been acquiring and managing commercial properties for over 5 decades. It earns rental revenue from long-term net lease agreements and pays monthly dividends to investors. You can look outside of the stock market too. For instance, some popular investing services let you lock in a steady rental income stream by investing in premium commercial real estate properties. From R&D campuses in San Jose to industrial e-commerce warehouses in Baltimore. Energy. One of the surest signs of surging inflation is in the commodities rally we saw earlier this year. In fact, commodity prices are commonly believed to be a leading indicator of inflation. So it shouldn't come as a surprise that oil, the most traded commodity in the world, is also on Kiyosaki's list. The price of crude oil has slipped over the past month, but is still up more than 40% year to date. As you'd expect, strong oil prices benefit oil producers. So far this year, investors have enjoyed outsized returns from names like Chevron, 40%, ExxonMobil, 51%, and ConocoPhillips, 84%. That said, investing in commodities is a particularly volatile undertaking. If you'd rather invest in something without the extreme ups and downs of stocks, cryptos, and commodities, take a look at a few under-the-radar alternative assets. Traditionally, investing in things like exotic vehicles or litigation finance or even marine finance have only been options for the ultra-rich, like Kiyosaki. But with the help of new platforms, these kinds of opportunities are now available to retail investors too. The real estate giant, Evergrande, itself recently warned about its growing financial difficulties. Evergrande alerted the global public that unprecedented problems are coming. The Chinese company is set to default on its debts, totaling a staggering $300 billion, which is likely to trigger a catastrophic financial chain reaction. Now, the latest analysis by experts this year has revealed worrying parallels with the events that led up to 1929 and today. According to Maury Klein's 2001 book, Rainbow's End, The Crash of 1929, several fundamentals of the previous crash can be applied today. In the book, he shows that 1 year before the crash, new listings on the New York Stock Exchange rose from 58 million shares in 1925 to 102 million in 1928. Burry mentioned that central banks in Basel III have more or less removed price discovery from credit markets, meaning risk does not have an accurate pricing mechanism in interest rates anymore. And now passive investing has removed price discovery from the equity markets. The simple thesis and the models that get people into sectors, factors, indices, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Michael Burry Secrets. Bye.